Okay, so as we get this kicked off, uh, like I said, make sure you have your notepads ready. I'm going to move through this rather fast tonight. What we're going to be going over is a study guide that not only are you going to be able to write this out on your exam, but you're going to be able to literally have an open book test. Now, this open book test process only works is if you know the definitions, if you know vocabulary. So I'm going to draw out a couple different things tonight on things that you need to be studying. So if you are not prepared for this exam yet, and you're saying, okay, I don't know how I'm going to pass this. Good news is we're going to make it happen tonight, okay? So when you walk into the exam, you're going to have a sheet of paper or a dry erase board. They give you 2 hours to pass this exam. You cannot draw on the sheet of paper until you press start. So what you're going to do is you're going to press start on the test. Don't even look at the answers. And the mindset going into passing this exam is we're going to read each question twice out loud before we even look at the answers, because we need to know what is the question asking. We're going to work process of elimination. So get two of the most redundant question answers that we know absolutely are not right. And then we're going to go at our gut to always go with the answer. If we don't know it, go with our gut. If our brain says, okay, go with this one, go with that one. And we're not going to change our answers. One of the big reasons people come up short on this exam is because they doubt themselves. You know this, Jessica. It's just some people doubt themselves. And Tanisha and Lindsay, we're going to make sure that tonight you are prepared. Okay, so the first thing that I'm going to start off with, I'm going to be flipping through my book personally, is we're going to talk about the types of policies. In your exam, you're going to be able to, I also draw out a T-bar. What do we know the differences between term? Term is temporary. Whole life is permanent. Term insurance is normally leveled premium. Whole life is normally leveled premium also. Whole life insurance matures at 100 and it builds a cash value. All right, now we know the differences between term life and whole life. Now there's different versions of whole life, different versions of whole life insurance, but we need to know the skeletons of these. Permanent insurance, it's leveled for most part. It matures at 100 years old and it builds a savings vehicle, right? So let's go through the 4 levels of term insurance. The first one is going to be called level term. That describes that the death benefits and the premium stay the same. The next one is going to be called decreasing term. Next to decreasing term, I want you to write the word mortgage. This is used for a mortgage. The way decreasing term is set up is that you pay for this policy, you covered on a mortgage. Let me see if I can find this chart. So decreasing term, you should look at it this way. The premium stays the same, but the death benefit or the face amount decreases every year. So just an easy way to remember this. The premium's always going to stay the same on a decreasing term policy. And think of it like a mortgage. The balance of your mortgage should go down every year. So does the death benefit. So you could start off at a $50,000 policy here, paying $25 a month. By the time this policy is worth $10,000, you're still paying the $25 a month. Does that make sense? The next one is going to be called annually renewable term, also known as ART. The things that we need to know about term or annually renewable. This is known as level terms. It's leveled for that 1 year. It renews every year. It renews annually without a medical exam. Every year when the premium goes, every year that it renews, the premium increases. That is all you need to know about increasing term. I'm sorry, decreasing annual renewable term. The next one is going to be called increasing term. This right here is generally used as a rider for the cost of living. So you might even see this as a cost of living rider. This is attached to a policy. That's all you're going to need to know. That's all you need to know. We don't need any illustration stuff. The next one is called return of premium. ROP. This is actually known as increasing term. The way this works is if you don't die before a certain age, they return your premium that you paid into it. That right there is all you need to know about term insurance, except as far as the types of policies. There is what is called renewable and convertible. Renewable means that you can renew the policy without evidence of insurability. Convertible converts to whole life without evidence of insurability. That's everything we need to know about term insurance, guys. Another thing that we could write about term insurance is called its pure life. Any questions on that? Perfect. I hope you guys got that.
Before with the renewable term and stuff, so I can finish writing that down.
No, I'm gonna give you the recording so you can go back and rewatch this.
Okay, okay.
Like I said, I'm going to move at a very fast pace because this is a lot of information. But I want to make sure you guys get this. Okay. So let's talk about whole life insurance. Whole life, it has a cash value. The premiums are normally leveled. It matures at 100. And when it matures, that means that the policy owner would get the life insurance. I'm sorry, the policy owner would get the life insurance. This also has what is called a guaranteed death benefit. This right here is the skeleton of all whole life insurance policies. Okay. So we're going to keep this as simple as possible. There is something called whole life, ordinary whole life, and traditional whole life. These all mean the exact same thing. And what I just told you right here, this definition right here describes those three types of whole life insurance policies. So they're all level term. They all mature at 100. They all have a guaranteed death benefit, and they all build a cash value. So if you see these three types of words, that's what it's describing. Okay. The next one, it's called limited pay or single premium. The two types of limited pay is life at 65 and then 20-year pay life. The definition of these is in the word. This is you pay until you're 65 years old, policy's paid up. 20-year pay life is you pay for 20 years, policy's paid up. And then the other one is single premium, where the policy owner pays a lump sum and the policy is paid up for the rest of its life. The one thing we want to know about single premium whole life is that when you pay a lump sum, the cash value grows immediately. For most whole life insurance policies, the cash value will not grow until the third year. That is all we need to know about whole limited pay. You guys good on that? All right. The next one is going to be called adjustable life. Adjustable life, and now we're starting to get into a little bit more complex policies. But to keep adjustable life insurance simple, this is a combination of term plus whole life, meaning you can mix in and out of these types of policies. What I want you to remember is this: the policy owner chooses two options. The life insurance company chooses one. What are these options I'm talking about? Remember, in a adjustable life insurance policy, the policy owner can either choose the term, the premium, or the coverage. So the policy owners can say, hey, listen, I want this amount of years. I want this amount of coverage. So the insurance company is going to choose the premium. Or the insurance company, the client can say, hey, I want to choose this amount of premium. I want this amount of coverage. Well, the insurance company will say, well, this is how long you can keep the policy in force. So adjustable life. It's a combination of whole life and term. The policy owner chooses two options. The life insurance company chooses one. Any questions on that? Okay. Let's go on to the next one. Universal life. Let's go over a couple of the bullet points with this one. Universal life is known as annual renewable term, also known as ART, plus cash value. So what do we know about annually renewable term insurance? The premium increases annually. It increases yearly. So if we know the premium increases yearly, universal life insurance gives you two options to pay. The first one is called the minimum premium. And the insurance company gives you what is called the target premium. So give you an example. If you have $100,000 policy, they will give you a minimum payment of $70 a month. But they're going to encourage you to pay $140 a month, so double the premium. So you're going to keep paying this to keep the policy in force, but they're going to recommend you pay this because it will build the cash value faster. Now, every year since the premium is going to go up, you won't pay it. You won't see the premium increase like dramatically. That's over. What happens is when you, because you get premium, universal life option gives you an option to what is called skip payment. So if you want to skip a payment, you can, because all they're going to do is drain that payment that you skipped from the cash value. So they give you the option to skip payment. That's okay, skip it. They're just going to take it from your savings account or your cash value. What is very sad about these policies is that if you don't keep up with this target premium, eventually they are going to send you a bill in the mail saying, hey, your new premium, I'm just going to give you a number here, is $200 a month, maybe 20 years down the road, because your cost of insurance has gone up, Tanisha. If you don't pay that new premium and they have no more money to pull from your cash value because that is gone down to zero, if you don't pay that premium, your policy will now what it do call it's called lapse. Now your policy is gone. All the money you paid into that policy is gone. Okay. That's how universal life insurance works. Now, there is the death benefit option of universal life. So this is universal life continued. So the death benefit options, Lindsay, how this policy will pay out. Option 1 is called level death benefit, where just simply means that if this loved one passes away, your family gets the death benefit. Then option 2 is called increasing death benefit, which all that is the family gets the life insurance plus the cash value. This is the only scenario where a client gets the life insurance and the death benefit. In all other whole life insurance policy, Lindsay, the family loses the death benefit. I'm sorry, the family loses the cash value and they only get the life insurance. So if you see on the exam, option 1, a key word you want to look out for is the word corridor. If you see the word corridor in the question, the answer is option 1. Automatically choose it. Don't second guess it. Move on to the next question. All right, we good to go on that? All right. There are a couple other policies I want you to come look at. It's variable life and variable universal life. Those policies are just simply read it and get an understanding of how it works. There's nothing too difficult about those policies, okay? The next thing I want to move into is annuities. There's 2 types of annuities. There's fixed and there's variable. I just draw a T-bar right here just so I know the differences. The difference between variable and fixed is this. Fixed gives you a guaranteed interest rate. Variable, not guaranteed. A fixed annuity, the insurance company puts your money into what is called a general account. Because the variable, you are taking the policy owner or the annuitant is taking the risk. They put your money into what is called a separate account. They separate the funds. Fixed annuities, in order to sell this, you must have your life insurance license to sell. If you want to sell variable, you need your life plus securities license to sell. Last thing we want to know is this. Fixed annuities don't keep up with inflation. Variables does keep up because the accounts are a little bit more risky. And sorry, guys, my handwriting is not neat as far at all. I just hope you can catch on to my words as I'm saying this. That's all you need to know about the difference between fixed and variable. So when you're reading questions and it says, which of the following fixed or so-and-so bought a fixed annuity, you should be able to say, okay, fixed annuity. It's guaranteed account. Money goes into a separate accounts. Insurance companies, I need a life insurance license to sell this. Your concept should go there. So that describes the risk tolerance of an annuity. Let's talk about how you pay into an annuity versus how you receive money. So when you pay into an annuity, I always like to draw this mountain. You are going to pay into this annuity and you're going to invest money over time, and your money is going to grow tax deferred. So you're not going to touch this money for years, and you're not going to owe taxes on this. But when you withdraw money, you're going to owe taxes on it. So as you are accumulating money over the years, this time period is called the pay-in period. Also known as the accumulation phase. And because you are the accumulation phase, your money is converted to accumulation units. When they say the word units, I like to describe that as shares. So this entire time period, you are paying into the annuity. The money is yours. You could cancel this annuity at any time. If you do cancel it, you are going to be hit with surrender fees. But if you decide to pull money out for whatever reason, the money is going to be taxed based off of LIFO, which means the last dollar in is the first dollar out. So as you're paying into this annuity, Lindsay, you are going to say, hey, I've been paying into this thing for 20 years. I'm ready to start to receive my money. The moment you come to the top of the pyramid, top of the mountain, you've accumulated your money. Now you're going to enter the time where you're going to liquidate your money. So the pay-in period becomes the payout period. Also known as the annuity phase. Also known as the annuitization phase. Also known as the liquidation phase. Those all mean the exact same thing. And your accumulation units are now converted to annuity units. So now you're starting to receive money based off of how you decide to want to receive money. The only other thing you need to know about annuities is the time period that you can start receiving. So I'm going to move over to another page right here. This is the last thing I'm going to write about annuities, is how you pay into it. You have single premium, and then you have flexible premium. Every time you see the word single premium, think of the word lump sum. So if you do single premium, you can receive the money in two ways or within two time periods, which is immediate annuity or deferred. When you see the word immediate, I want you to think less than 1 year or less than 12 months. Deferred is after 1 year or after 12 months. And then when it comes to flexible premium, you can only have flexible premium deferred annuity because you have not had enough money invested over enough time to get it in less than a year. So if I could draw if all this was on one page, the way I would describe it is, let's just say you took a line right down the middle of that little mountain. And everything that's on the left side of this dotted line describes how you pay into it. That line went down there. And everything that was on the right side described how you received the money or how you receive it. Does that make sense? Good. Okay. Those are two major parts on the exam that you got to get down. One of the acronym or three acronyms that we're going to go through are what are called non-forfeiture. You guys remember that acronym or the letters? R stands for reduced paid up. E stands for extended term. And C stands for cash surrender. Remember, the non-forfeiture options is what is known as your cash value. This is the money that can always be used. Okay. So reduced paid up. The definition of this is where you take a lump sum of the policy, you take whatever the cash value will buy, and you buy a smaller face amount of coverage. So now you're done paying on the policy. That's what reduced paid up means. Extended term. I will make sure I give the exact definition of this one. Okay. So the extended term, the insurer uses this cash value to convert whatever the face amount is into a term policy. This right here is going to be what is called the automatic option. Remember that. The insurance company wants to keep the money in-house. If you don't tell them what to do with the money, they're going to do it. So again, the cash value uses the money that's in the term within the cash value to buy that same coverage, but in a term policy. And then cash surrender is you take the money and run. You're cashing the policy out and you're just taking whatever it is and you're leaving. Any questions on this?
Can you repeat reduced paid up is what again?
Reduced paid up is where you're going to take a single premium. So you're taking all the cash value that you can have and you're going to buy a smaller face amount. So at that point, you're done paying on it.
Thank you.
Yep, good. All right, that's all you need to know about non-forfeiture options. The next acronym you're going to need to write is what is called your dividend options. Remember, a dividend is nothing more than a return of excess payment. So you overpaid. They are just giving you your money back, and they are going to give you options of what to do with your money. The acronym for this is called CRAPO. C stands for cash, where you just say, hey, give me the money back. Thank you. They send you a check. R is going to be reduced or reduction of premium. In this example, you just say, hey, I don't want the refund. Apply that to my next year's premium, the next year's payment. The A is going to be what is called accumulation at interest. And this example is where the dividend is kept by the company. You tell them to invest that, and whatever that interest grows, they just add that onto the policy. Remember, a dividend is not guaranteed. A dividend is not taxable because it's not a return. It's not a profit sharing. It's a return of premium. But if you invest that dividend and they gain interest, that interest is taxable. Anytime your money earns money or whatever, it is always taxable. The next one, the P, stands for paid up additions. Paid up additions is where you're going to use the same money that you're already getting, that little premium, and you're going to use a single premium to increase your death benefit. I want to say this is the automatic option too. Let me verify. Yeah, this right here is the automatic option also. And again, if you don't see me writing out the definition, it's just because it's too long to write on this. But make sure you understand that paid up additions is you're buying more coverage with that same money, and you're going to use the dividends, the cash value, to pay to buy more coverage. The second P is paid up insurance. So what happens is, first, the insurance company gives you these dividends back. They invest it, and then you gain interest on that. And you take the cash value to pay the policy off early. So paid up addition insurance, Tanisha, is nothing more than you say, hey, listen, the money you're giving back to me, we're going to invest that. Plus, we're going to take the cash value to pay the policy off early, so you're done paying on it. The last one that it is 1 year term, where you simply just take a 1 year policy for whatever that premium will buy you. Any questions on that? That is all you need to know about dividends. The last acronym I'm going to give you is for settlement options. This right here is how you receive money from your annuity. This can also be how you receive your money from your insurance company, from your life insurance, but I'm gonna keep it simple. Again, C is gonna be called cash, where you see a lump sum. They're just gonna give you the check and say thank you. L stands for life income. And just like the word sounds, you receive money for the rest of your life. The thing about life income, it actually gives the highest amount of money monthly, quarterly, however they're paying it out. The bad thing is if you die, whatever money is left over to pay out to you goes back to the insurance company. Unless you have life income. I'm just going to erase this definition right here just for a second. Just so I can write that out. Unless you have life income with period certain, which simply means, Tanisha, that if you have a 15-year period certain and someone passes away in year 5, that still leaves 10 years for the beneficiaries to still receive the money. Okay. Okay, and the I is going to stand for interest only. Next to that, I want you to write temporary option. That means you tell the insurance company, hey, listen, I don't know what I want to do with the money yet. Just invest the money, pay me the interest, and we'll figure out what we do with it later. This is the most flexible one. Again, if you choose to invest the interest, whatever interest is earned is going to be taxable. And then the last one is going to be called fixed period. And then fixed amount, which simply means this is a fixed time period of how the money is going to be paid out. And then this is a fixed dollar amount that will be paid out until exhausted. Any questions on that? Okay. Last thing that we're going to cover is retirement accounts. So the two type of retirement accounts, there's qualified and non-qualified. Keep this simple. Qualified are regulated by the IRS. These are not regulated. Qualified accounts have tax advantages, such as tax deductible income. I wish I could spell deductible. Just tax deductible income, right? I'm just going to put that there. Over here, not tax deductible. This right here, if you pull out before 59 and a half, at age 59 and a half, the IRS will hit you with a 10% tax penalty on your account. If you pull money out before 59 and a half, there's no penalties over here. But anytime you withdraw, obviously you're going to pay taxes on it. The last major thing on qualified accounts is this cannot discriminate and who gets to take advantage. They can discriminate. So if a corporation decides, hey, listen, only our executives are going to be able to take advantage of our profit sharing plans, nothing the employees can do about it. That's just what the company decides to do. Okay. Any questions on this? Pretty straightforward, right? Okay, so let's talk about the type of retirement accounts. We have a 401k, 403b. We have a KEO plan. We have a SEP. A 401k is an employer sponsored plan. That's all you need to know. A 403b is also known as called a TSA. Another word for that is called tax sheltered annuity. These accounts are used for your nonprofit organizations, your teachers, your nurses, and anybody else in that field. A KEO plan, another name for that is called HR10. This is for small business owners. That 10% is 10% ownership in the company. So 10% ownership in the company. And SEP stands for Simplified Employee Pension. Only things you want to know about this is that a person can put 25% of their income away. This is a very high, it's a popular plan for your small business owners. Besides that, the last retirement accounts we're going to cover is your IRA and your traditional IRA and your Roth IRA. So let me move on to the last thing. Oh, forgive me. All these accounts grow tax deferred. So all this money is tax deferred. So you pay money, you pay taxes on this when you withdraw from the account. Okay. So let's talk about a traditional IRA. So a traditional IRA works like this. You can put $7,000 a year. That income is tax deductible to the person. So you can actually take this money off your tax bill. If you are over the age of 50, so 50 plus, you could put in $8,000 a year. That is called the catch up period. An IRA, you must pull money out by 73 years old, or there is a penalty. The penalty has changed since the last time I took this exam, so I'm not going to give you that number. But I know the age is 73. And the money is taxed based on tax deferred. The only way to invest into a IRA in general, the money must come from earned income. That's going to be your salary, wages, or commissions. That right there is all you need to know about traditional IRAs. Okay. Let's go into what is called your Roth IRA. Same thing. Contribution limits. If you can just kind of copy this over, 7,000 for the year. 8,000 if you're 50 plus. Money is not tax deductible. So on this one, you cannot deduct your money from your taxes. There is no penalty. You can leave the money in there for as long as you need. There's no penalty after 59 and a half. If you still pull money out before 59 and a half, you still have that 10% tax penalty. That applies for all qualified accounts. But there's no penalty like at age 73 you have to pull out. You can pull out and you can leave it in there as long as possible. The money grows tax free. So you realize all the other ones is tax deferred. This is the only account that grows tax free. So if you put in $1,000 and it grows into 1,500, that $500 growth is tax free. The government will not tax that. Pretty cool. What was the last piece I had on here? Okay. Same, like I just said, this is only through earned income. Besides the last thing you really can know about a Roth IRA is that if the account is 5 years old, you can use a portion of it for your first time, for a down payment for a home, for a first time home buyer. You can use it for post secondary education. Also, you can use it for your medical expenses. That right there, y'all, is a big portion of the exam. I gave you a lot, but I wanted to explain it to you like this in this scenario. So you could listen to this over and over again. And I just gave you probably over half the exam. The stuff that you have to go back and reread for yourself, for your sake, is laws and regulations. I cannot teach you that. That's just something you have to learn. The other thing is you have to spend time on provisions, writers. You do have to spend time on that. That's one that I can't help you get away from. It's so if you're going to pass your exam this week, memorize this. I would even try to write out some extra little notes that you say, okay, I'm not going to remember everything. But what if you practice writing that out crazy amounts of times over the next couple of days? And you're just like, oh my gosh, I got it. I know this definition. I know this definition. I know that. You do that over and over and over again. Eventually you'll be like, I got it. So in between now and your exam, go back, do the flashcards, learn terminology, reread the question twice before you look at the answers, and just make sure you memorize that right there. That's a big portion. And I hope you can actually understand my handwriting. I said it, try to say it slowly so you can pick up on it. If my spelling was inaccurate, congratulations. I grew up in Jacksonville, Duval. It's what we do. We don't spell right. We spell Duval with a bunch of U's. we'll actually do Boston. But I gave you guys a lot tonight. That right there is a cheat sheet or study guide that I used myself to pass the exam. But also add whatever little ones you want to add for your own sake. So, you know, I need to know this. But besides that, guys, let's go kick some ass. I will not be available tomorrow for study. I have an event that I'm doing, so I will not be available. I will let you know about Thursday night if I'm available. But as of right now, that is that we will not be meeting tomorrow night. Okay. Good. We'll go kick some ass. I believe in you all. I can't wait to hear your passing scores. But go enjoy your night, ladies. All right.